All right, so let's jump into option assignment 101, how this process works, and what we should be able to watch out for in this process. Probably spend 30-45 minutes, and that will be the last session for today. Alrighty. Okay, so let's gonna talk a little bit about the basics of options, exploration, assignment, the process. Then we'll jump more into the assignment part of it, right? So for someone new to the options, the exploration assignment could be a little tricky, right? It's a mystery. Sometimes I think exercise is not a mystery, but assignment is always a mystery. Two of you have done, you follow the trade from your friend, you got assigned, he did not, or she got assigned and you did not, and you were wondering what the heck is happening here. How could we both did on the same day, and then someone gets assigned, someone doesn't get assigned? It's always a mystery. It can be scary as well if you don't know the basics or what to do once you get assigned. So today we're gonna break through the whole process of option assignment, exploration, what's involved in it, what you don't have to worry about it, and if you get assigned, what to do. Right? So we're gonna go through all of that. If you have questions, feel free, ping in between, and then we'll take it from there. Why we have to worry about this whole expiration assignment? Because unlike stocks have no expiration date, but options have expiration date. They all expire on a particular day. We all know about it. Other thing is, in US, options are regulated by OCC, right? OCC is it guarantees all the trade. So if I buy an option, say call option, and it goes in the money, and then I want to buy the shares, so OCC will make sure that I get the shares, right? Or if I bought a put option to sell the shares at a particular price, and if I want to exercise that, OCC will guarantee that I am able to sell the shares. I don't have to worry about what if the other party refuses to buy the shares, right? So OCC Act guarantees all the trade, right? It is also a kind of regulator or overseer to make sure that both the parties, the one who has bought an option and one who has sold an option, they do their part of a contract, right? I don't have to run behind it. It's OCC will take care of it, right? And it's a participant in every option trade. Talking about exercise versus assignment, I use the two words, right? Option exercise, option assignment. In any option trade, you have two players. One is a buyer, one is a seller. Okay. Now, exercise is initiated by the buyer, or it will be auto-initiated by the brokerage of the buyer. And we'll talk about it, at least on the US, when it is auto-initiated. Now, assignment, so option buyers, they have a right to exercise. Remember, you paid the premium to get that right. And now you can choose to exercise your right whenever you want to. Assignment, we call it assignment when the option is assigned to the seller. Let's take an example. I bought a call option to buy a share of my favorite ticker XYZ at $50. And at option expiration, let's say it closes at 50. Right? Or it closes at, let's say, 60 or 65. I want to buy at 50. I can exercise my right. Now, so when I go and call my broker saying I want to exercise it now, or I want to buy the shares, it means I'm exercising my right to buy the shares, which the call option, because I bought the call option, that gives me the right to buy the shares. Now there will be some party who would have sold the call option. I don't know who that is. OCC will take care of it. Not that call option, but there's someone who would have sold a call option on the same ticker at 50. Now, when I send my request, that request will get assigned to one of those sellers saying, hey, you sold a call option, means you gave someone else a right to call the shares from you at $50. The person who had a right is now requesting the shares. So that's why we call it as the word assignment is used for option seller, and word exercise is used in context of option buyer. So far, so good. Option sellers have an obligation to perform as per the assigned contract. If you get assigned the option, you have to do, as per what your contract was. So if you have sold a call option, you have to give the shares. If you have sold a put option, you have to buy the shares. Now, I talked about that either you can, if you're an option buyer, you can initiate the exercise process, or in this case, there is an automatic exercise, right? Now, for in the money options on after expiration date has passed, OCC has a provision for auto exercise. Any option that is more than 1 cent in the money, it will be automatically exercised. For example, if I, going back to the same example of XYZ, I bought a call option at $50. Now, at expiration date, at the end of expiration, let's say 15 September was a recent expiration, right? Market closes on 15 September, and now the stock is trading at $50.01. Now, in that case, that will be automatically exercised. That means come Monday, I will have 100 shares of XYZ in my brokerage account, because the call option give me the right to buy the shares. So now, because it is 1 cent in the money, it will get automatically exercised. If the stock is trading at $49 or anything less than $50, then it is out of money, then it expires worthless. Nothing will happen. But if it is even 1 cent in the money, it will get automatically exercised. So if you bought an option, call or put, and you don't want to exercise it because it is $50 1 cent, right? Not really worth for me to buy the shares, because I buy the shares. Who knows that on Monday the share could open at 49. So I buy at $50, and the share on Monday could open at 49. That's a loss for me. Okay. Maybe I bought this call option thinking that the shares will be available to me at $45. Sorry, the shares will be at $60 opening on Monday. Then I can buy it at 50 and sell it at 60. Right? So if you don't want to exercise it, then you have to actually call your broker and tell don't exercise it. Or you can close your option trade before the market closes. Otherwise, if it is 1 cent in the money, it will get auto exercised. Yeah. All right. Any questions so far? Too fast, too slow? Make sense? Give me some feedback. Or should we jump onto the macro? Shall I continue on this one? All right. Okay. Well, let's continue on this one. Let's look at the overall assignment process. Like I said, it's a mystery, because the way it works is like this. If I'm a call holder, I hold a call option for XYZ at $50, and I want to exercise this. I call my broker and say, hey, I own this call option, I want to exercise it. Or probably on your platform, you may have a way to exercise it on using some mouse clicks. So my broker, which is a call holder broker, it will send a notice to OCC saying, oops, I have a person who holds a call of XYZ as 50 who wants to exercise his right of buying the stock XYZ at 50. OCC will randomly select a member form. Member form means all these brokerage houses and all that stuff, right? So OCC will randomly select anyone. They could pick up TD Ameritrade, they could pick up Charles Schwab, they could pick up Tasty Works, they could pick up, there are whatever many other brokerage firms. They could pick up Robinhood and send a notice to them saying, I got, and one of the, any of these firms would have some customer in that firm would have sold a $50 call on XYZ. That may not be the one that I picked up, but someone would have sold any one of, this call. They will send a notice to any member and say that, we have a exercise of XYZ at 50. Your brokerage firm, some have sold a call. They don't know who sold it. So they'll send a notice to them to exercise it. Now the option seller brokerage, and now there are millions of option sellers on that brokerage firm, and hundreds or thousands of them could have sold XYZ call at 50. They will randomly pick up, maybe either on first in, first out basis, or could be random. They pick up a name and say, okay, you are assigned this. So once that person is assigned, you will get a notice saying, okay, option assignment happened. Now, because the process is random, it is possible that if you sold a call and I sold a call, you might get assigned a call, but I may not. Because it is a random process. Now, after the call writer has been assigned, so the broker will get 100 shares from whoever has sold the call. And if that person did not have a shares, the account will end up into short 100 shares and send a notice to OCC, hey, we got the shares. Those shares will end up eventually through my broker, and those shares will come into my account. So come Monday, I will see those shares in my account. So now this is how the process works. And this whole selection of who the call will be assigned to is a little random. So sometimes if I said, hey, I got assigned on the stock, you may not even get assigned on the stock for a few days. Right? Now let's talk about the settlement. Once you get assigned on a stock, right, how the settlement happens. So settlement, one is called physical settlement, means you have to actually deliver the underlying equity. So if I sold a call at XYZ, then once this exercise happens, I get assigned, then I have to deliver the shares. So that's called a physical settlement. I mean, it's really electronic settlement. It's no physical shares that have to take it, but the name still, from a historical name is still sticking to it. That's called a physical settlement. The other one is called cash settlement, right? Let's talk about the other one, which is cash settlement, in which you can't deliver the underlying security. For example, if you're trading in indexes, right? If you go and look at indexes, there are, you can't buy the index. You can buy, there are no shares on those index. There's no, you have a SPY, which is an ETF issuer, and you can buy SPY, but you can't deliver XPX or RUT or NDX. These are option stock indices. These are cash settled. That means if at the end of a day, if I bought a call option on SPX at, let's say, 4,500, and at the end of expiration, the stock is at 4,600, then it will be cash settled. I will not get SPX shares because that doesn't exist. All I'll get in my brokerage is the difference between these two. 4,600 minus 4,500, I will have $100, or it's because it is a one contract, 100 multiplied by 100, I will have a $10,000 in my bank account. So the net profit and loss, you will see your brokerage account being impacted by net profit and loss, the dollar value. In physical settlement, you will see that your portfolio constitution has changed because you got some SPY or you got some shares or some shares were taken away from you. But in case of your tickers that are only cash settled, it's only the exchange of the dollar value because you can't sell or buy the underlying. Right? So generally, when does this happen? Right? So this is one question which a lot of new option investors / traders struggle with is, let's say I sold a put option because I'm okay to buy this XYZ at 50. Let's say I sold it for October 20th expiration. 10 days later, which would be 26th of September, XYZ goes to 45. So the question is, hey, because now it is in the money, will I get assigned? Is there risk for me? Will I have to come up with $5,000 now? So generally, when does this happen? I mean, that's one question that's generally perplexes the new option players. So though the options can be exercised anytime, because the option buyer can exercise anytime, so the option seller can be assigned anytime throughout the life cycle. Most of the exercise happens in the week of expiration. Generally, it may happen maybe on the last day of expiration. So if the stock goes to 45, 10 days later, I don't have to worry about it because October 20th is still far away. Now, there are cases when you may have to worry about, and we'll go through that. But generally, it happens in the last week. Right? Because there's a reason why the option buyer will not do it, because of the extrinsic value, which is still remaining in the option. Right? We'll come back to this extrinsic value to see when you could be at a risk of early assignment. Right? So the assignment will happen if the option is in the money, because if it is out of the money, then as an option buyer, I will never exercise my right because that's not profitable for me. So I will let the option expire worthless. If the option is in the money and the option is closer to expiration, and like I said, the most of the assignment happens in the last week. So there are some cases in which you could have option assigned 3 weeks, 4 weeks before the expiration. So October 20th is expiration. There is a possibility, there is a chance that if I've sold an option, I could get assigned next week itself. Okay. When will this happen? If I have a deep in the money put option with very low extrinsic value, right? Remember I mentioned why the option buyer will not exercise it sooner, because if they exercise it sooner than the expiration date, then they will lose all the extrinsic value. But if the extrinsic value is already very low, then there is not much loss anyway. So one, it is in the money, deep in the money with a very low extrinsic value. Number two is if you are sold a call and there is a dividend coming up. Now, this is very important. Even experienced option investors sometimes get stumped by the fact that, you're there, you have an option that expiring on September 29th, which is like 2 weeks away, and over the weekend, you get an email, you've been assigned. What the heck? It's still 2 weeks away. It is because you had a short call and there's a dividend coming up. Okay. I will take some examples. So let's talk about short put first. Say you sold a put option, either naked or a part of a spread, really doesn't matter. So you gave the right to the buyer to put the shares to you, right? So buyer will be able to sell the shares to you. It means by selling the shares, the buyer of the put option get cash and you will get the shares in your account. Short call, You have sold a call option, either naked or a part of spread. You gave the right to the buyer of the call option to call the shares from you. And by exercising the call, buyer get the shares from you, means if you hold the shares, they will disappear and you'll get the dollars in your bank account. Right? So short in the money put option. In this case, let's say your stock price was 50, put strike price is 55. So put price is $5.03. In this case, the extrinsic value is only 3 cents. So there is a chance that even though this may be October 20 expiration, there is a chance that you could get assigned this one because the extrinsic value is very less. Generally, you will see, it might be 1 cent, etc. Then there could be a chance that you could get assigned. Same is the case on the call options, right? Stock price is as 50, call strike price is as 45. Means the buyer of the call option could buy the stock from you at 45 and sell in the market at 50 because currently stock is trading at 50. And the call option currently is being traded at $5.02, means the extrinsic value is only 2 cents, very low extrinsic value. So this could be at early risk of assignment. So it's important to keep an eye on extrinsic value. Now, this is an interesting case wherein I have a extrinsic value of 82 cents, but this could still be at a risk of assignment because maybe I sold XYZ has declared a dividend and it's going to be X dividend come Monday. And even though it is October 20th expiration, and on Monday, which is 19, I could get assigned this year because I sold a call on it. So if this is not clear, feel free to ask questions because this is a very important portion to understand. It is because the dividend is more than the extrinsic value remaining in the option contract. Now, the buyer of the call option would, for them, this is a dividend capture strategy, right? By exercising it earlier, they are losing 82 cents, not losing, but this is extrinsic value left, which they're not able to make use of, right? So kind of losing 82 cents, but they'll get the shares and capture 90 cents in dividend, right? So basically it's a 8 cents of profit. That's one way to look at it. Is if your dividend is coming up and it is more than the extrinsic value, then you have a very high risk on assignment. And when I say high, I mean the probability is almost 99 to 100%. Because if the difference is only 1 cent between the extrinsic value and the dividend, maybe won't do it. Because, hey, if I go to exercise and it costs me, $1 to exercise it, probably I won't do it. But in this case, yeah, the buyer will definitely exercise their right. And then I will definitely get assigned. So again, this weekend I had, because I have a lot of QQQ short calls as a part of my delta hedging. And then I saw a note, I think Tastyworks said, hey, you have a short call option. This is going X. I'm like, what? That's the trouble, right? It's the end of a quarter. And looks like QQQ is going X dividend next week. I'm like, oh, I need to look at all my options. And then I had some short call at 350, 345, which are deep in the money. And then I went and look at what's the QQQ historical dividend. That's around 50 cents. So now I had to look at all my short calls where the extrinsic value is less than 50 cents. So the deep in the money, let's say 340 call, 350 call, where they had like 8 cents extrinsic, 10 cents extrinsic. Now I need to act on it. Otherwise, I'll be short 100Q and I'll get the dollars in my brokerage account come Monday. right? I'm sure to get assigned on these ones. So if you're doing, let's say, selling calls as a part of your covered call strategy on a dividend paying stock, then you have to pay attention to the extrinsic value remaining in that short call. Okay. Now, this is another example of a short call with an upcoming dividend. But in this case, the dividend is less than the extrinsic value. I have no risk of assignment. So it's not that every time when a dividend is coming up, you will get assigned. No, it depends on the extrinsic value remaining in that call option. So far so good. All right, moving on. We talked so much of the importance of extrinsic value. Where do you find the extrinsic value? And that's why that's the reason why I don't like these Robinhood apps and all that, because they don't even show it. Maybe now they have graduated to show you these additional information, which is very important if you are a serious option trader, right? So this is on Thinkorswim. You can actually configure to show the extrinsic value right here on an option chain. So in this case, let's say you're looking at 50, let's go $50 strike price. Extrinsic value is 60 cents. Okay. But let's say you don't have Thinkorswim or Tastyworks, they also show the extrinsic value. But say your brokerage platform doesn't show you the extrinsic value. Is there any other way for you to guess what the extrinsic value of that option would be? So if it doesn't show the extrinsic value, what you can do is, let's say if you sold a call option and there's a dividend coming up, you want to know what's the extrinsic value left in that call option at that strike price, go and look at what the put option is being sold at. It's not the exact match, but it will be fairly close to the extrinsic value left in your call option. So if you're on a Robinhood platform, I don't know if Charles Schwab shows it or if E-Trade shows the extrinsic value upfront or not. But if those platforms don't show you the extrinsic value, in this case, let's going back 50, let's if I don't have this, I can see what's the put option is being sold at 61, 66. I'll take maybe 62 or 63. It's not exactly 60, but close to it. Okay. So that's another way to find the extrinsic value if your platform doesn't show it, is to go and look at the corresponding put option and see what the put option is being sold at. Now, if the upcoming dividend is more than the value of put option, then there is a higher risk of assignment, right? Because it's more than the extrinsic value. Not a perfect science, like I said, but it does the job. It will keep you out of trouble. It will keep you out of surprise assignments that otherwise you will wake up to on Monday. So what to do if you really find out that, oh, I'm at a risk of assignment. I sold this call option or I sold this put option. And now, even though October 20th is far away, Monday, this will get assigned to me. So now on Friday, well, the market is still open. What can I do? Right? If I'm at risk of assignment, number one is to manage the trade. If you're a naked call, maybe close the call. Because if you don't, or if you're okay to get assigned, you sold a call because let's say it's a naked call, so you don't have a share. So either you close the position or you roll it or do whatever you want to. If you have a covered call, if you don't want your shares to be called away, then you close the option trade. You buy back the short call. Or if you're okay to sell your shares at 50 because you sold a call option at 50, then just enjoy. Over the weekend, OCC will do the job. 100 shares of XYZ will move out from your portfolio and you will get $5,000 in your account. But let's make sure that you're aware that this change is going to happen. If you hold a stock in which dividend is coming up and you have a deep in the money call option, avoid that surprise. Okay. Short put. If you sold a put, and if you want to hold the shares, then make sure you have enough, buying power in your account. So if you sold a put at $50, make sure you have $5,000 worth of buying power in your account, because you will get the shares in your account. If not, and you don't want to own the shares, maybe you just did it just for option premium sake, you really didn't want to own the shares, then close the trade on Friday itself. But say you try to do all this, you still got assigned because you were busy, things happen, life has some more demands, you got distracted, and then you got assigned. And so what to do if you get assigned? If your portfolio can, more important, if you want to, then hold the position. What I mean by this is, if you get assigned a short put, and it was a naked short put, you did it, let's say you sold a strangle on SPY, and now the short put expired in the money. Now you get 100 shares of SPY, which is almost $45,000. If your portfolio, if you want to hold those 100 shares of SPY in your portfolio, then hold it. And if that doesn't make it too big a position size for your portfolio, you can just hold it. Or do you want to think, okay, what do I do? Do you want to sell some of it? Or do you want to implement risk reduction strategies like selling covered call or whatever? You decide what you want to do once you get assigned. Right? If you don't want to hold the position, then come Monday morning, sell the shares back in the market. But you got assigned those shares, let's say SPY at 450, there's no guarantee that Monday morning the stock will open at higher at 450. Okay? But you don't know what the market will do. So you have to bite the bullet, and you think this has become a too big position of your portfolio, then reverse the transaction or sell some portion of it. That is why it is important to know if your position is at a risk of assignment, so that you can avoid all these things. If your position, what will happen if your portfolio can't hold the position? And these are the cases when you get a margin call from your brokers. Say I sold a call option, and now I didn't have a shares, so it was a naked call option. And my portfolio is not big enough to hold that position. Broker will give me margin call and say, hey, you have to add more to your portfolio. Right? Now, some broker will provide some time to come up with the funds. If you can't add the funds, then the broker will sell some of your positions to raise the funds. Right? Now, these are the cases wherein we see noise, newbie option traders get caught up and into this is and they're scared of getting margin calls. But if you understand the process, how it works, and if you position size it in the right way, you don't have to worry about any of the margin calls. Best is to avoid going through the assignment process by closing the option trade upfront. If you really don't want to hold the position in your portfolio, means if I really don't want to hold as 100 of SPY in my portfolio, then I would rather close it on Friday and not let it go through the assignment process. I see one comment, pre-assignment. Yes, I've been dumped on short put recently, RMH, RH, SMH stock. Okay to buy these shares at discount. Yeah, if you're okay to hold the position, that's fine. Just that it shouldn't be unexpected. All I'm trying to say, you shouldn't be surprised that, oh, I got assigned. Oh, I didn't plan for it, right? Maybe, SMH, whatever its price at, I wanted to buy SMH. Mine is October 20th. Yeah, I have plans to add more funds to my brokerage platform on, let's say, end of November. But now I got assigned on Monday. I didn't have enough funds on in my brokerage. Now my cash balance will be negative, means now I have to pay margin to the buyer, to the broker for buying, for taking a loan from them, right? So also all that stuff. So if you know, go through the process, then you know that on Monday this thing will happen, and then you can decide what you want to do, right? That's the whole objective. Or keep your position size small to avoid the margin call, right? Don't sell a naked put on SPY, because that will need $45,000. Maybe sell a put spread, right? Or instead of doing 10 contracts of a put spread, maybe do only 1 contract or 2 contracts. Follow the guidelines of position size. So, final takeaways: options can be exercised, assigned anytime. Now, I'm not covered one aspect, which is a little more deeper, is American versus European. So if anyone, so European options cannot be assigned anytime, but those are far and few. For the retail investors, newbie retail investors, almost all options are American options. It means those can be exercised, assigned anytime, even though there is a 3 weeks left in expiration period. However, mostly happens during the end, very near to the expiration, because of the extrinsic value which is still remaining, right? The whole theta decay that we talk about, it decays day by day, slowly and slowly, and very, it's only near close to the expiration period that the extrinsic value will reduce to minimal. But there are cases when you can get early assigned, and those are the cases when there are dividend coming up. I think that's the other case could be, let's say, a case of J&J, right? Wherein they had spun off a company, and if you hold J&J share, you get some little bit of preferential treatment for buying shares of the spin-off company at some discount and all that stuff, right? So those are the special cases in which someone may want to buy the shares, get the shares, and not wait for the expiration, or is okay to do away with the extrinsic value or lose the extrinsic value because the reward is higher. The dividend is higher than the extrinsic value. Or I can get more discount on Kenvue shares. I don't know, did J&J give on Kenvue or not, but let's say I can get a spun of shares at a discount which is more than the loss in the extrinsic value. Those special cases, you could get assigned sooner than what you may be expecting. Now, once you get assigned, check if the portfolio can hold the position. Otherwise, do the reversal transaction. So if you were sold a call and now you're negative shares, buy the shares from the market. Now, once the market closes and it opens on Monday, next trading day, it's anybody's guess whether you're going to make money or lose money on the reversal. It could open higher, it could open lower. No one knows. Right? Otherwise, to avoid going through it, close the position sooner, right? So that you don't have to go through the whole hassle of assignment process. That's all about assignment exercise. Open for questions. We're done for today.